All right, let's get right into it. For so many of us, that car insurance bill is just this huge expense we grit our teeth and pay every month. But what if the whole system itself is fundamentally broken? Today we're going to dig into a pretty provocative question based on some really compelling research.
Scam. I know, it's a really strong word, but let's be honest, it's probably crossed your mind, right? Especially when you see your rates go up, yet again, for what feels like no reason at all. Well, the source material for this analysis doesn't pull any punches. It asks if that feeling is actually justified.
In fact, the research here describes the industry not as a service, but as this, an institutionalized extraction mechanism. Whoa, that's a very fancy way of saying it's a system expertly designed from the ground up to pull money out of your pocket. So how on earth does it work?
Okay, to really understand the problem, you have to start with this central conflict that's baked right into the for-profit insurance model. It's this fundamental paradox at the very heart of the industry. And this right here just lays it all out perfectly. On one hand, the whole idea of insurance is kind of beautiful, right? It's about community. We all chip in a little to protect each other from a huge disaster. But, and this is a huge but, the companies providing this have a legal duty to their shareholders to make as much money as possible. And the simplest path to profit? Collect more in premiums than you pay out in claims. So right from the get-go, what you want and what they want are in total opposition.
So because of this built-in conflict, you end up with something that doesn't really work like a normal free market. Instead, it operates much more like a machine, one that's built on a very specific and very powerful foundation.
And that foundation is what's called a captive market. Think about it. In pretty much every state, you are forced by law to buy car insurance. It's not a choice. If you don't, you're looking at fines, maybe getting your license suspended, or even jail time. You can't just say, you know what, the price is too high, I'm out. The government has essentially created a permanent guaranteed customer base for the entire industry.
And this is the consequence, right here. When you're forced to buy something from a private company, your payment starts to act like a tax. But here's the kicker. Instead of funding public goods like our roads or schools, this private tax gets funneled directly into corporate profits, shareholder dividends, and those massive executive bonuses.
This system also creates this powerful, kind of hidden incentive. Insurers take all of our premiums and create this massive investment fund. It's called the float. They make a fortune investing this money. So the longer they can hold on to your money by, say, delaying or denying your claim, the more investment income they make. This has led to an industry-wide strategy that has a name: delay, deny, defend. So let's bring this down to earth. How does the system actually translate into real-world costs and consequences for you, the driver? Now, you'd think your insurance rate is based on, well, how you drive. But a lot of the time, it's not. Insurers use a whole list of non-driving factors to guess how risky you are, and these often just act as stand-ins for how much money you have. You can be penalized for having a blue-collar job, for renting instead of owning, or even for being recently widowed, a practice so common it's actually been nicknamed the widow penalty.
And maybe the most shocking example is credit scoring. Study after study has shown that a driver with a perfect record, no accidents, no tickets, but a poor credit score, will often pay a higher premium than a driver with an excellent credit score who just got a DUI. I mean, just let that sink in. It's completely backwards.
And this reliance on socio-economic data creates these massive systemic problems. Even when you control for income, research shows safe drivers in predominantly black neighborhoods pay on average 71% more than drivers in predominantly white neighborhoods. It's basically a modern-day form of digital redlining.
And it's not like this is a super competitive market either. Just 5 big companies control over a third of the entire industry. They create an oligopoly that pretty much sets the pricing trends for everyone else.
So while drivers were getting slammed with double-digit rate hikes, the executives at the very top were doing just fine. In 2024, a year of record profits for them, the CEOs of just the top 10 insurers took home a combined $134 million.
Okay, so if that's the problem, is this just how it has to be? Are we stuck with it? Not at all. It turns out there are proven, successful alternatives to this for-profit model.
The most common alternative is something called a mutual insurance company. The concept is actually really simple. The company is owned by its customers, the policyholders. That's it. There are no Wall Street shareholders demanding bigger profits, which completely gets rid of that core conflict of interest we talked about. Any profits go right back to the members. And this really works in the real world.
State Farm, one of the biggest insurers in the country, is a mutual. After a profitable stretch, they recently announced they were returning a massive $5 billion dividend directly back to their policyholders.
Now, beyond mutuals, some governments have even created their own public nonprofit insurance systems. But the most common path for reform, at least here in the US, is just aggressive state regulation.
The best example of this is California's Proposition 103, passed way back in 1988. It forced insurers to roll back their rates, it required them to get public approval for any future hikes, and, this is the crucial part, it required them to base rates primarily on your driving record, not your zip code or your credit score. The results were absolutely dramatic.
Over the next 27 years, consumer advocates estimate that Prop 103 saved drivers in California an astounding $154 billion. It's pretty powerful proof that strong regulation can work to protect people in a market where they're forced to be customers.
So where do we go from here? Well, the next big battleground is technology, and it has the power to either finally fix this system or to make it a whole lot worse.
The key innovation here is telematics. You probably know it as usage-based insurance. We're talking about those little devices or smartphone apps that track your actual driving habits in real time, how fast you're going, how hard you brake, what time of day you're on the road. The promise is huge to finally make insurance about one thing and one thing only, how you drive.
And this brings us right to the final, crucial question. Could this technology finally deliver on the original promise of insurance? Could it create a truly fair system, one based on your actual risk, that rewards safe drivers and makes our roads safer for everyone?
Or will it just become the ultimate surveillance tool? A system that gives insurers even more data to justify high prices, to find new high-tech ways to penalize you, and extract profit from a market that you are legally forced to be a part of. That's the challenge, and you can bet the answer is going to define the future of what you pay.